From the fixed income perspective, the Indian markets are going through very interesting times. On one hand, you have benign inflation, you have very low credit growth, you have very low investment demand for money, and if you look at all these variables, we would believe that interest rate should come down. On the other hand, we have a central bank which is slightly cautious, or maybe you can call it slightly hawkish, and therefore you have this market which is vacillating between a benign outlook and a slightly hawkish outlook. If you add up the offshore part to it, I think it's more confusing because you have now European markets and US markets seeing uptrend in the interest rates, and obviously that is adding up to the volatility on the Indian market side. So if I add up all this, I think the markets will be volatile going ahead, but the trend according to us will be slightly uptrend. So we are kind of bottomed out on interest rates, but it's very difficult to catch the last 25 basis point. But more or less, we think that interest rates should be trending upwards. The way we look at credit is slightly different from the way the market looks at it. When we look at the credit environment, we find out, or we try to establish a fact that how easy is it for the companies to pay us back if we lend them money. And obviously one key parameter to look at is, are the operations improving for the company? Because the better operations generates better cash flows, and it's easy for the company to pay us back. On that parameter, it looks good. Economy is doing much better than what it was a few years ago. Apart from good operations, it also helps if the company can raise equity from the equity markets, and with your index at all-time high, I think it's relatively easy for companies now to raise equity. And if that's the case, it's easy for them to deleverage their balance sheet by raising equity. The second point could be if you had some good assets in your balance sheet. We have an environment today where it's easy to sell if a good asset which you would have. Maybe you have a good power plant or you have a good cement plant. So we have seen many of these acquisition deals happening, which means that again it's easy for a company to deleverage by selling some of the assets. Other way to look at it is how is the banking liquidity. The banking system is huge amount of liquidity lying in the banking system, and again it's very easy for companies to go for refinance through a banking system if the liquidity is very high. Lastly, the offshore markets are doing very good for India. So for Indian corporate to raise money through ECB or through a masala bond, I think it's again much easier. So if you add up all this, if the operations are improving, if the company can raise equity much easier and faster, if the companies can sell some of the assets if they want to, if the companies can tap the offshore markets, if you add up all things, I think the credit environment is much better than what it was a few years ago. Oh, indeed, the more different type of players comes in the market, it helps the market grow, it helps the market become more liquid. So earlier you had a case where your provident funds and pension funds were the only large buyers in the market. Over a period of time, we saw mutual funds coming in a big way, and now mutual funds contribute a large amount of liquidity to the market. So today we have, from the domestic side, you have insurance companies, mutual fund, banks, pension funds, EPFO, which is obviously making the market much more liquid. The only missing part to some extent was absence of foreign players. The last couple of years, we have seen huge interest among foreign players to come to India. Within these foreign players, the good part is that we have different kind of foreign players who comes in. Someone who comes with a very long-term view, maybe a sovereign fund, somebody who comes with a very trading view, a very short-term view, somebody comes in with purely emerging market expertise. So if you add up all this kind of different players coming in, and the domestic players which are increasing by every year, I think over a long period of time, I think we'll see a good secondary market for Indian bonds, which definitely helps to deepen the corporate bond market in India. The demand supply dynamics on the corporate bond fund is now favoring demand. When we started this business on maybe 8-9 years back, we were the only large players looking at anything which was below AAA. By regulatory reasons, the insurance companies and the provident funds used to always buy up to AAA or only AAA bonds or government bonds. And we were the first few guys to jump in this market 7-8 years back. Over the last 7-8 years, we have seen many different players coming in, and today, if I'm not mistaken, maybe some 40 mutual funds have corporate bond funds. With all these 40 mutual funds having corporate bond funds chasing the same assets, the demand for these companies or the demand for such securities have gone up sharply. Luckily for us, because we were holders of the securities for a long period of time, luckily for us, the secondary supply of these bonds are very low. So if you have a limited supply from the companies because the credit growth is not too high, and you have 40 funds looking to buy, I think the demand supply is favoring the demand side. Lately, we have seen the provident funds being allowed to buy below AAA assets, which again adds up to the extra demand. So I think next few years, till the time the credit growth picks up very sharply, we think that on the demand supply side, it will be the demand will be much bigger than the supply of these corporate bonds. Frankly, I may not be the best guy to talk about strategy for the mutual fund investor, because there are different type of investors with different risk appetites, and therefore you will have to have different products for them. But if you ask me, a overall question of where are the interest rates headed, I think interest rates kind of bottomed out in India and maybe headed higher. And in that scenario, your actual kind of funds with higher coupons and lower maturity, we think is kind of better placed as compared to long-term GSEC funds or dynamic funds. But having said that, the dynamic funds and income funds and GSEC funds also have their own place. So if somebody wants to take opportunistic trading views or trading calls, I think those funds will also come handy. But if you are an investor looking for staying put for 36 months or more and you want steady returns, we think overall accrual funds with lower maturity makes more sense in this kind of market environment.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.